Hey, what's up everyone? Welcome into the channel. My name is Brett with Investing on the Go. Today we're going to be talking about NEOS versus TAPPAlpha non-leverage versus leverage funds. I just watched a video recently on another channel on the NEOS leverage funds, and I wanted to do a deep dive myself to see which of the leverage funds is best for me to begin, dabbling in and investing in. So I'm going to go ahead and take you through what I looked at and what my two winners are here in this video. So with that said, if you guys are brand new here to the channel, I would really appreciate if you go down below, smash that subscribe, smash that thumbs up, and check out the pinned comment down below to join the Discord server completely for free. And with that said, let's go ahead and get into it. So we have right now sitting at a little over $9,000 of cash, which has me thinking I want my money to be working for me in the market. I do realize that the market is essentially less than 1% from all-time highs, but just dabbling a small amount at a time, about 500 to 1,000 as an initial start, and then dollar cost averaging in could be beneficial in these leverage funds. So we're going to go ahead and start off by taking a look at the SPY related non-leverage and leverage funds, and then move into the NASDAQ. So let's pop over to the NEOS ones. Okay, so we're going to go ahead and focus on the NEOS SPY non-leverage versus leverage. So everyone's pretty familiar with SPYI. This is one that I was invested in very heavily back in 2025. It's pretty much one of the original covered call ETFs that I began investing in. It has a monthly payout, an expense fee of 0.68, which is pretty reasonable, a distribution rate of 12.24, and I average out the last 3 months of distributions has been about 0.51 per share. So here as a starting amount, I went ahead and put $5,000. If we were to invest $5,000 at a current price of roughly $52.52, we would walk away with 95 shares, times that by the amount of dividends that it distributes. And on a monthly basis, we would get roughly $48.45, or on a yearly basis, that would be $581.40. So that's kind of a really good base right there. Okay, now let's go ahead and move down to the leverage fund. So ticker symbol XSPI. You'll notice this is a 50% leverage on top of the SPYI. So you're paying here a management fee of 0.98. So that's a 0.3% boost that expense fee, but you're getting a 50% leverage on that capital without taking margin in your account. This fund is doing it all for you, hands off. You're going to get amplified to the upside. You're going to get amplified to the downside. I would recommend watching how these work, how they perform on a daily, weekly basis in comparison to the underlying asset that they follow, which is SPYI, and kind of just see how it plays out. They do have a monthly payout similar to the SPYI fund. Their distribution, now here's where the big thing here jumps quite a bit. The SPYI distribution is roughly 12.24. The XSPI distribution is at a whopping 17.05%. Now, I think this is a little bit much. I'll talk about why here in a moment, but this is a boost of 4.81% above the non-leverage funds. They pay out since inception back in, I believe, February. They've paid out an average of 0.67 cents per share, but they've never consistently paid out the same. It's been downtrending for a while. For the past 3 months, it's essentially been downtrending, I believe 3 cents or so, and it really hasn't plateaued yet. So that would be something I would want to watch for. The distributions right now are not, it's not equal right per month. So this is something I'd still want to watch for where it kind of bottoms out at. So if we took $5,000, we invested it at the price it was on Sunday when I was recording this video, it would come out at $49.01. That would get us 102 shares. So you're kind of getting within the same share count, roughly 7 shares, but the higher distribution here, that payout of 0.67 would put you at a monthly payout of $68.34, nearly a $20 monthly difference. And on a yearly basis, check out that yearly difference of $820.08. So that is $260 difference just by the same amount of funds, but just a higher payout just because of how leveraged it is. you're going to get more capital appreciation, but in a downwards market, you're also going to get that depreciation or, negative. Okay, so that is the SPYI non-leverage funds. We're going to be now looking at the price. This is where I think that distribution is a little bit high on the boosted fund. So here we're comparing the normal, this is SPYI, this is dividends not reinvested. It has a price return. Since it was created on February 3rd, SPYI has gained 4.51% just price-wise. We have the non-boosted at negative 0.2, and we have the boosted here at negative 0.8. So, I would like to see this obviously not be into the negative, but this is pulling just from a few weeks ago, a few, months ago now, as this originated back in February. We did get to essentially all new highs within the SPYI, but these ones are kind of negative at the moment. And today, Monday, was negative, so these kind of pulled back a bit more as of recording this video and having the data here on the chart. So I would like to see the distribution kind of maybe bump up or go down just a smidge to kind of keep that price more in line while still having a good, reasonable distribution. Now, dividends reinvested. Here is where we want to be invested into these boosted funds because we're trying to make our money nearly have that same return as the underlying assets. So here, SPYI with dividends reinvested is at a 4.8, followed right behind with the boosted fund at 3.51, and then the SPYI non-boosted here at 2.85. So these are the NEOs versus the SPYI total return with dividends reinvested. You can see, it does a lot better than the original SPYI with dividends reinvested. You're definitely getting that boost. So you can see here during that downturn in March, that amplification from being 50% more leverage. You can see here it was in line pretty early on, and that leverage really pushed it down. You can see not quite hitting negative 12, whereas the SPYI bottomed out roughly hitting almost negative 10%. This one went a little bit beyond that, right? It hit roughly negative 11 and some change, and then recovered, actually recovering past its SPYI, and then come in here in second just recently. So amplification in both directions can be seen. Now, moving over now to the TAPPAlpha funds, we're going to be looking at the SPYI non-leverage versus the leveraged one. So this is one that I'm very familiar with. I moved from SPYI to TSPY. It has been doing really well for me. Same thing here, payout is on a monthly basis. Their expense ratio is exactly the same. Now here's where that difference starts to take place. The distribution on TSPY is a little bit higher than 12, right? It's at a 14.56%. They pay out roughly 29 cents per share, and you can see that their share price is a bit lower, almost half the price of SPYI. So when you're investing $5,000 at $25.34, instead of getting that 90 some shares, you're going to get 197 at 29 cents per share. It's going to come out to $57.13 on a monthly basis, or $685.56 on a yearly basis. So now that we kind of covered the non-leveraged fund, let's take a look at the leverage fund. Okay, this is where it makes a difference in the NEOS leverage versus the TAPPAlpha leverage. First of all, NEOS is 150%, right? It's 50% leverage, whereas the TAPPAlpha funds are 30% leverage. Another big thing here that I noticed that these have a weekly payout. These are not monthly distributions. As with the XSPI, this is on a weekly basis. Now their expense ratio here, you're paying, again, 0.98. So you're paying 0.3% more for a leverage fund, but you're not getting the same bang for your buck. Instead of getting that 50% leverage, you're only getting 30% leverage. So that's something that I saw right away. So it's on a weekly basis, 30% leverage. You're paying that high expense ratio that's in line with the NEOS funds. Their distribution, you'll notice that the non-leverage is at a 14.56. The leverage is at a 14.74. So it's only higher by 0.18%. So what I'm looking for when I saw this is that, hey, it's leveraged by 30%, but it has a higher expense fee. I believe that with that leverage and the expense fee, it's not going to work out the math, and we're probably going to either see more deterioration because of the higher expense fee and same exact distribution. But I wanted to leave it up to see what happens here. So on a weekly basis, this fund has been paying out roughly 6 cents a share over the last few weeks. So that's kind of what I use here. So $5,000 invested at a current price of $23.26 would net you roughly 214 shares at 6 cents per week. That would give you, on a weekly basis going forward, roughly $13.92. On a monthly basis, that would be $60.35. And on a yearly basis, that would be roughly $724.21. So the thing here is, looking at this, you're paying a much higher expense fee. You're not getting that much more in terms of boost, right? You're paying 0.3% more. You're getting 30% leverage here. Is it worth it? Your distribution is remaining roughly the same, where the dividends that are being distributed back to you is essentially almost the same as the non-leveraged fund. So here's where we're going to look at the price comparisons. So this is just price appreciation, depreciation since inception, or I wanted to match the dates as the NEOS funds. Okay, so SPY remains the same. Price has moved up roughly 4.51%. You'll notice here that the non-leveraged fund in price is actually doing better here. It's in second at 0.48%. So the amplification here of 30% amplification is pushing it really far down to the downside. Plus, it has those higher management fees. So that's amplifying the cost of this fund and amplifying the loss. And even on these uptrends recently here in April, we had an amazing April, basically wiping out all the losses that took place and then moving to all-time highs. But the amplification to the upside just didn't do too well. You can see right here, it's kind of staggered out these last few weeks. So the TSYX here is still down price-wise by 2.46%. But you're thinking, let's take a look at total return. So next slide, total return with dividends reinvested. First place, still SPY here at 4.8. What would you think would be in second place? If you guessed the leverage fund, you are wrong. Still, in second place, you have the non-leverage fund with dividends reinvested up 2.96%. So here you have a non-leverage fund beating the leverage fund here. So the leverage fund with dividends reinvested is only at a 2.21%. So it's lagging behind by 0.7%. And that could be due to, once again, management fees. That amplified loss with management fees just can't recover those gains, even with the amplification. So right now, because of how I'm seeing the data currently running with the TAPPAlpha TSYX, I do not think it's a good leverage fund versus the underlying TSPY. So right now I'm more focused on the clear winner here being for the SPY covered call equivalent of not only really the price, but total return being XSPY. You can see here that if we were to invest $5,000 and we're just looking at dividends and distributions alone, SPY would be 48 on a monthly, XSPY would be 68, TSPY would be 57, TSYX would be roughly $60 a month. So 68, that XSPY, the NEOS leverage fund, comes out on top with distributions. In terms of yearly income as well, it almost makes $100 more in distributions on a yearly basis. And then when we're looking at price wise here, I went ahead and put in all the funds that we were kind of monitoring here, and we can see S&P 500 just price is up 4.51. In second, we have TSPY, that price is at 0.48, and then we have SPYI at -0.2. We have the XSPY at -0.8. This is where I do think that the distributions from XSPY could maybe pull back slightly to not have that NAV issue. But more history will help with knowing how this is in a year from now. But as of now, I think that distribution might need to be pulled back just a bit, right? It's okay to be pulled back just a bit. And then in the worst position, what's this right here? The leveraged TAPPAlpha XSYX is down negative 2.46% with just price alone. So I kind of made the note here on XSPY. While it is the winner of the leverage funds, being down by 0.8%, it could be a little bit high in the distribution. The total return winner is definitely XSPY. So here, SPY with dividends reinvested is a 4.8. XSPY is at 3.51. So it does lag behind just a bit, less than 1% behind. No, actually a little bit over 1% behind, but still, it does have really high distributions. If you take those distributions, you're using them to, pay your expenses down, you're only losing a bit in that NAV. But if you were to reinvest those distributions back in, your total return would actually be coming in pretty good, right? And almost, second place versus the other ones here. Third place was the TSPY. Fourth place was the SPYI, and in last place here was the TSYX. So I'm going to be sticking with, if I invest into a leveraged SPY related covered call fund, right now I'm looking at XSPY for the SPY related one. So that is S&P 500. Now let's go ahead and talk about the NASDAQ equivalent ones. So let's go ahead and take a look at the NEOS QQQ non-leverage versus leverage fund, similar to what we did prior with the SPY. So NEOS, again, everyone is super familiar with QQQI. This is one that I, once again, was heavily invested in back in 2025 before moving over to the TAPPAlpha equivalent. So same thing, monthly payout, expense ratio of 0.68. Distributions, you'll see here that this is a little bit higher than the SPY, right? They have a distribution of 14.32%, or over the last few months, they've averaged around 0.622 on distributions on a per share basis. So we take $5,000, we invested it at the price of $54.56. We get 91 shares, times that by that dividend per share. We're going to get roughly $56.60 on a monthly basis, or $679.22 on a yearly basis with that $5,000 invested. Now, the boosted fund here, XSPY, same thing, very nice. 50% leverage to the upside and a downside, so just be aware of that. Again, it's on a monthly distribution, so that's nice. Expense fee, you are paying again that 0.3% more expense, but hey, you're getting 50% more leverage here, so that's good, more bang for your buck. Distributions here, they have a whopping 20.62 distributions. That is huge. That's a difference of 6.3% over their non-leverage fund. They do pay out 0.81 per share on their distribution. So $5,000 invested into XQQI at $50.49 would get you 99 shares. So you're going to get more shares. Amplify that by that distribution of 0.81. You're going to get a whopping $80.19 per month. So that's a difference of what, $24 and some change. Crazy. And then on a yearly basis, you're seeing nearly a $300 difference just by investing into the boosted fund. But is it worth it, right? Let's go ahead and take a look at the price. Boom. So price. Here we're comparing QQQ, our base price, with no dividends reinvested. So it's up 9.35% since these were all, created at the same time. They all have math at the same time. In second place, hey, that's what we want to see. We want to see these leverage funds pop up and overcome when the market's doing well, right? When the market's doing negative, right, it's going to have amplification to the downside, but when it does well, we want to see it recover. And in second place, it did recover. It's up 2.77% with no dividends reinvested. And then the QQQI is up 1.96% with no dividends reinvested. So overall, these are not losing any NAV since inception. They're doing pretty well. Let's go ahead and look at total returns. So here we are with total returns. QQQ with dividends reinvested 9.49. The XQQI is with dividends reinvested at a nice solid 8.23%. And then the non-leveraged one here is at a 5.62%. So with those distributions being reinvested into the fund, you're getting really close to that underlying asset here of 9.49%. So I think that XQQI is a pretty solid gaining leverage fund at the moment, right? So that is the newest ones. Let's dive into the TAPPAlpha. So TAPPAlpha, QQQ, non-leverage versus leverage. So TAPPAlpha, we have TDAQ. Again, this is one that's gigantic in my portfolio as well. They have a monthly distribution expense fee of 0.68, which matches the QQQI distribution, a little bit higher, right? We saw the distribution of QQQI at 14.32. This one has a distribution of 16.8 or 36 cents per share. $5,000 invested at roughly $26.79 as of May 1st. Going to get you 186 shares. Times that by that average distribution. That's been pretty fair. This has been a really good one. Been really close on a monthly basis of 0.36. It's going to give you $66.96 on a monthly basis, or $803.52 on a yearly basis. Now, jumping into the leverage fund, once again, you're getting 30% leverage more from TDAQ onto with TDAX. Their payout ratio is on a weekly basis. So instead of those monthly distributions, you're getting this every single week paid out to you. Your expense fee increased by 0.3%. So you're paying 0.3% more for just 30% leverage versus on XQQI, you're getting that 50% leverage. So we'll see how this works out. Distributions here, you can see once again, the distributions do not jump up that much between the non-leverage and the leverage. It goes from 16.8 to 17.54. That's only a difference of 0.74% more in distributions. Now they do pay out a dividend here of around 7, almost 8 cents per share every single week. So $5,000 invested at $24.02 would get you 208 shares at 0.079. That would net you on a weekly basis $16.43, or monthly around $71.21, and in a year $854.57. So pretty interesting. You're not really, invested into these for the distributions. You're invested into these to get the amplification of return with the price. That's kind of, what I'm looking at right now is what you're kind of getting into, because those distributions are not any higher. Now, price wise, we're just taking a look at price. No dividends reinvested. QQQ is up 9.35%. In second place, we actually do not have the amplified one. In second place here, we have TDAQ. TDAQ is up 5.10%. No dividends reinvested. And then we have TDAX, the leverage fund, up only 3.98%. So the leveraged took us to the downside a bit more. You can see here, whereas the QQQ was down a little over, between 9 to 10%. The non-leveraged TDAQ was down roughly 10%. That TDAX was down more than 13. It was down around 14% during those March lows before recovering, and it hasn't quite recovered. Maybe here with some time, it will overcome and take over TDAX, but as of right now, it hasn't done it. So TDAX is outperforming it by a little over 1% there. So that's with dividends not reinvested. Dividends reinvested though, here you're taking those weekly distributions, and instead of taking them as distributions, you're reinvesting them and buying back more shares. So here you took, everything kind of started up about the same. As the market fell, the amplification of 30% leverage to the downside amplified it. But during those weekly distributions, if you were buying in at cheaper and cheaper and cheaper prices, you have more shares near the bottom, right? You took those distributions, buying back more shares, and then when the market recovered, all of your shares amplified to the upside, and you did see that the TDAX did overcome it in the end with that total return up 10.11%. So this is the only case so far where the leverage fund overtook the base here. QQQ is actually at 9.49. So here, this is interesting, right? The leverage one came in first. The non-leveraged TDAQ came in second at 9.7, and then the base ETF here, QQQ, came in third with dividends reinvested at 9.49. So that's pretty interesting right there. I did want to point that out. So with dividends reinvested, that amplification from TDAX would actually put you up in first by quite a bit. Okay, so let's look at the QQQ equivalent covered call winner. In total return, I would say it's TDAX, but it depends what your goals are. If you're looking for a total return, TDAX would be a total return winner. But $5,000, if you're looking for those dividends here and you're looking at the distributions, XQQI, that higher distributions of 20-some%, you're getting that 50% more leverage. You're going to get roughly $80.19 on a monthly basis, or a whopping $962.28 on a yearly basis. So that is huge. Also, you're not losing a whole lot. Here we have the prices on the side with no dividends reinvested. First place, we have QQQ at 9.35. Second, we have TDAQ at 5.10. Third, we have TDAX at 3.98. Fourth, we have XQQI. So this is just price alone, no dividends reinvested, 2.77. And then in last place, we have QQQI at 1.96, dividends not reinvested. Now, total return wise, TDAX actually comes in first. So here we have the amplified one here. TDAX is up 10.11. TDAQ, the non-leveraged TAPPAlpha, is at 9.7. The QQQ, the underlying NASDAQ here, is at 9.49. Then we have the boosted NEOS fund at 8.23, and then trailing behind by quite a bit, we have the QQQI, the non-leveraged NEOS fund at 5.62%. When looking at the winner of the NASDAQ series, it really depends. If you're looking for total return, TDAX is your winner. If you're looking for distributions with still pretty good returns, then XQQI is going to give you that monthly and yearly huge distributions right there. Now, here is the prices, prices with dividends reinvested after Monday, right? Monday, we have a bit of a pullback. TDAX, that leveraged TAPPAlpha, is at 9.72. TDAQ, QQQ, XQQQI, then QQQI. Here's all your QQQs up here towards the top. Then you have your SPYs. You have SPY in first in terms of, dividends reinvested. Then you have your leverage XSPI. Then you have your non-leveraged SPYI. Then you have your TAPPAlpha TSPY. And then you have your leveraged TSYX. So in terms of SPY funds, XSPI is definitely the winner. In terms of QQQ funds, TDAX, TDAQ are both really good. If you're not looking for that amplification, TDAQ has done really well for me. But if you are looking for those extra dividends and you're okay with the extra amplification to the upside and to the downside, XQQI is going to give you more performance than QQQI. So that the winners here of this specific thing here, in terms of SPY covered call winner, I would say that the XSPY is clearly the winner, and not only dividends, right? Distributions are huge from this fund, but and also covered call total return. It's almost keeping up with the underlying asset SPY, just slightly staggering by roughly 1%. But, also that 0.3% management fee that you're paying more, you're getting 50% amplification versus just 30% with the TAPPAlpha funds. Now, when it comes to the NASDAQ covered call winner, I would say dividends wise, again, the NEOS XQQI is clearly the winner here. $5,000 invested would get you roughly $80 a month, or $962 boosted in a year. That's a huge, difference between the other NASDAQ funds. When it does come to total return, say you don't need the capital right this day, you're completely fine with dividends being reinvested. The TDAX, those weekly distributions, when the market's falling down and you're getting that higher distributions and you're able to buy back more shares as the market's falling, it does seem that when the market does recover, that amplification from having more shares, from being 30% leveraged, it does seem to amplify the total return up higher. But that's going to come with a cost, right? You're paying that 0.3% more management fee for only 30% more leverage. You're not getting that much more in distributions. Honestly, I would say that the 30% more leverage is probably not worth the cost of the management fee. I would stick more with the XQQI just because of the 50% leverage, the less volatility that I saw in the charts even during the downsides, and those distributions that you're getting, they seem to be more controlled versus those weekly style ones right now with TAPPAlpha. Overall, I'm pretty happy with going through these and kind of seeing them firsthand. I myself, while I do enjoy the TAPPAlpha non-leverage funds, when it comes to starting with the leverage funds, I myself will probably more than likely begin targeting into the NEOS XSPY and XQQQI. I don't know if it'll be this week where I begin to invest into these specific funds, but we do have some distributions and dividends getting paid out to us this week, so definitely stay tuned for that, and subscribe and follow along for that. But I do want to get some of the cash that I have sitting in my account just kind of invested and see it, right? As soon as you buy the stock and it begins to move down, that just means that, hey, now you're getting that sale. And if the market begins to sell off a bit more, that could be a good portion, a good time to begin rolling some of my funds into those leverage funds to amplify the recovery process into the future. But who knows, right? I've still got to come up with a plan. Right now, I just did the research of which of the leverage funds I would enjoy most. And now I have to make the decision of where, how much capital do I want to start in these and what my plan is going forward for dollar cost averaging. So let me know down in the comments section below, guys. What do you think is the winner of the leverage funds, the NEOS or the TAPPAlpha? What other funds do you guys know that are leveraged that follow and track the S&P 500, NASDAQ, or maybe something else that you're invested in? Let me know down in the comments section below. And I do appreciate everyone for tuning in and hanging out. And be sure to go down below, smash that subscribe, smash that thumbs up, check out the pinned comment to join the Discord server, and I will catch you guys in the next one. Bye-bye.